What if the bond market is telling us something different from the headlines? Investors may be waiting for lower interest rates, but several market signals are not yet making that case. In this edition of Occasional Daily Thoughts, we look at inflation, federal funds policy, Treasury yields, credit spreads, and what those charts may be saying about the economy in 2026. The Federal Reserve's preferred inflation gauge, core PCE, remains above the Fed's year-over-year target of 2%. Importantly, the chart shows inflation had already started to move higher before the Middle East conflict. That makes near-term rate cuts less obvious than many investors may prefer. At LRG Wealth Advisors, we try to let the data lead the discussion. That means respecting signals that support our view and also respecting those that challenge conventional wisdom. One example is copper relative to gold. Copper often responds to economic activity, while gold often reflects caution. This chart is not definitive, but the recent improvement in copper relative to gold may point towards stronger economic activity and potentially higher market yields. Consumer inflation expectations also matter. Consumer behavior often reflects what households expect prices to do next. If expectations settle above the Fed's target, the Fed may have less flexibility to cut rates quickly. In our opinion, monetary conditions are neither especially easy nor especially tight. With inflation still elevated, geopolitical uncertainty still present, and the market not clearly demanding lower rates, the Fed may remain on hold until the data justify a move in either direction. One of the cleanest ways to listen to the market is to watch the 2-year Treasury. It often reflects what investors believe the federal funds rate should do next. Right now, the 2-year Treasury does not appear to be demanding a rate cut. That does not mean cuts are impossible. It does mean markets are not yet sending a clear message that the Fed must ease policy immediately. The 10-year Treasury yield has moved into an uptrend. That may reflect inflation concerns, continued economic resilience, or both. Yields do not have to move higher in a straight line, but the current trend deserves attention. Finally, credit spreads widened as the Middle East war began, but they have since narrowed meaningfully. If economic trouble were building quickly, credit spreads would often be one of the first places to show it. At the moment, they are not sending that message. So the message from the charts is mixed but useful. Inflation remains a challenge. The Fed may stay patient. Treasury yields deserve respect. And credit markets, for now, appear calmer than the headlines might suggest. Engage LRG Wealth Advisors so we may apply market wisdom to your financial plan and investment portfolios so you may live the life you imagine. For a closer look at these charts, you can find the full newsletter on our website. Link in description. This is LaRue Gibson with LRG Wealth Advisors. Take care.